Technical analysis is a widely disputed subject. Some claim to make steady profits using it, others firmly say it's all a hoax. So which is it? I personally know people on both sides, both hardcore mathematicians and statisticians who call any believer in technical analysis outright stupid. And I know traders who respond by saying, well then by all means call me stupid, at least I'm the one persistently ending up with the money. But first, don't forget to like and subscribe below. It costs you nothing and it will make your dinner taste nicer and puppies around the world will love you. Before we figure out whether technical analysis works or not, we need to establish what exactly technical analysis is. First of all, technical analysis is not a crystal ball.
Sir, we found a way to eliminate risk.
If it can be used to your advantage at all, it's merely a way to take the temperature on the markets, a way of figuring out the overall sentiment in any given equity, whether the market is greedy, fearful or indecisive, and to what degree those forces are currently at work. Secondly, just like a weather forecaster can never say with certainty whether it will rain tomorrow or not, he can only say so with a certain level of likelihood.
Temperature seems pretty high.
The same goes for technical analysis. But does knowing the market temperature then mean that that information can be consistently used to our advantage? Winning traders say yes, skeptics say no.
No! No!
Now, critics claim that technical analysis is backed up by nothing.
Nothing.
That there is no empirical evidence whatsoever of it working at all. They love to compare technical analysis to flipping a coin or playing roulette. Their arguments go something like this.
If 1,000 people each play 100 spins of roulette, a small number of those players will always come out well ahead, thus beating the odds.
That's not because they're better than the other participants or because they've found a way to beat the wheel, but rather because there will always be a handful of lucky ones, so-called statistical outliers, who will often enough place themselves in 3 standard deviations or higher. You just don't know in advance who those lucky ones will be, and once there are enough data points, those outliers will be there, because everybody will not get the same results just because they have the same mathematical expectations, and that's the point. Hence, over the course of a multitude of players, 1,000, and spins, 100 each, outliers are statistically expected and rather nothing remarkable. Or, as Oscar Wilde once put it, expect the unexpected. What the skeptics refer to here is the Gaussian distribution, casually known as a bell curve, where the bulk of outcomes statistically always land in the central parts of the graph and where extremer outcomes are exponentially less likely. A typical example of an applied Gaussian distribution is the IMDb scoring, where 68.2% of all movies fall within 1 standard deviation. This means that roughly 2/3 of all movies score within a range of 4.8 and 7.6. Hence, you'll have a hard time randomly stumbling across movies with a score of, say, 2.5 or lower.
You started a massacre! I caused the revolution! You betrayed the law!
Skeptics normally end their arguments by stating that neither is there any empirical proof that technical analysis works, for if they were, everybody would become a winner.
Winner, all numbers.
And yes, the skeptics are right. They are right indeed, for there is no empirical proof. But they're missing out on 3 important details that change the picture altogether. For hidden in the outliers, the zero-sum nature of trading and the fundamental structure of trading psychology lay some truths. Now, according to the skeptics, there will always be outliers, as in exceptionally lucky winners and losers. There just won't be any consistent individual outliers. Had trading been solely based on luck, they'd be right. In that case, you could have a winning year despite having the odds stacked against you, but you'd never win money in the long run. The only problem is there are more winning technical analysis traders within each standard deviation than statistically justified, thus beating not just the odds but also the very laws of statistics that the skeptics themselves depend upon. Traders who are consistent individual outliers. Now let's throw the zero-sum nature and trading psychology aspects into the mix. For excluding cheating and biased coins and wheels, flipping a coin or playing roulette are maths and statistics at their very core.
You want to build the pyramids? You gotta know math.
We know the statistical outcomes in advance, and everything entailed in the two can be measured and calculated ad infinitum. No willpower neither can nor will affect the outcome of any given flip or spin. This is the second part where the skeptics go wrong, for in their mathematical tirades, they're comparing apples to oranges.
All right.
For trading is much more than just maths. It's behavioralism at its finest. The very laws of human nature transformed into action. For the main movers of the markets are human fear, uncertainty and greed, not numbers. There's a famous quote by Bill Dries stating that technical analysis is more psychological than mathematical, otherwise there'd be a hell of a lot of rich mathematicians out there. This means that if trading were calculable, whatever result it come up with would automatically cease to work. Otherwise there'd be free money for everybody, which we already know doesn't work due to the zero-sum nature of trading. Hence, any knowing would automatically turn into non-knowing. For this reason, there cannot be an empirical formula on how to win at trading. The economy author Nassim Nicholas Taleb talks about this. He tells an analogy in which an expert warns a dictator that his people are plotting a revolution, one that will erupt within a year. The expert recommends a long list of countermeasures, such as lowering taxes, improving the schools and roads, tripling his police and military forces and so on, all of which the dictator enforces. After a year, however, there's been a revolution and the dictator has the expert executed for believing he's caused him to waste immense amounts of money for nothing. This is a prime example of knowing turning into non-knowing, and it properly reflects my point on technical analysis and why it cannot be empirically proven to work. However, this doesn't mean you cannot win at trading using technical analysis. It just means that the sharpest and most potent minority of traders are the ones who will end up being the consistent winners. These are the most capable ones at adapting and coming up with profitable counter strategies to the non-knowing of the competing majority.
Now, before I execute this order, are you sure you understand the risks of stock ownership?
Absolutely.
This is what Taleb calls anti-fragility, where you from a technical analysis point of view turn your non-knowing into an advantage. In this sense, accurately determining the market temperature or the proper counter strategy to the non-knowing all come down to your individual interpreting skills. For there is a right and there is a wrong, and the market doesn't give a rat's tail about anybody's opinions.
Aid
I
at
listen
all.
to you. Let me just finish.
Yeah, but part of your job is to listen to me.
Just like the weather doesn't care about a biased forecaster who wants his outdoor mud wrestling session with his accountant tomorrow to be sunny. So, we established that technical analysis does work. It just cannot be put into a formula due to its dynamic and ever-changing nature. But can the information we obtain always be used to our advantage? In theory, yes, it can. For good traders level with the market. They don't automatically buy, sell or short whenever the price reaches a certain technical support resistant line. They rather use fingerspitzgefühl to truly understand the most likely market reaction.
Shut up.
What I'm saying?
You were thinking. It's annoying.
But if you use technical analysis without really knowing what you're doing on the other hand, guesswork trading puts you at the mercy of luck. This applies to most technical traders, for few can actually interpret technical analysis signals in a long-term profitable way, despite they themselves believing that they can, for they're rather oblivious blind followers of non-knowing, thus causing them to make incorrect decisions that lose them money.
Wouldn't throw him to the volcano, but they did.
I know, for I used to be one of them. In that case, technical analysis does not work long term, albeit you can still win temporarily by being a lucky outlier. Sometimes it's hard to know which of the camps you belong to as a technical trader, especially when ego gets in the way.
I am a god. Everybody says, who does he think he is? I just told you who I thought I was. A god!
To sum it all up, both the skeptics and pro-technicians are in theory correct. Technical analysis does indeed work, but due to the zero-sum nature of trading combined with the knowing versus non-knowing, it only works for a tiny fraction of potent traders. The outliers, the consistent 4%ers who end up with most of the profits. For this reason, most technical analysis traders will always lose, and no formula can ever change that fact, which supports the critics' claims.
Gaming is gonna be my job!
But looking at the very question at hand, whether technical analysis works or not from a binary perspective, with a definitive yes or no, the skeptics are wrong. For the answer is yes, technical analysis does work. Before we finish, I would like to personally thank a dear friend of mine for a piece of advice he gave to me over dinner recently. My friend himself runs a successful YouTube channel of his own with an impressive 43,000 subscribers. He told me that the best way to grow your channel is to, quote, throw shit on the wall and see what sticks, end quote. That is a tip I surely have taken to heart, albeit with a minor amendment since there is enough of shit on the internet already. For that reason, I rather prefer to throw alleged quality pieces on the wall to see which ones turn into Rembrandts. So again, if you have any constructive feedback on how to improve this channel, please let me know in the comments section below. For this channel is made for you, not for me, for I already know everything I tell you. In the next episode, we'll dig deep into some technical counter strategies that will improve your chances of becoming a successful 4%er.